When Amazon reported another quarter of massive AI spending, many investors expected the market to worry. After all, the company is investing hundreds of billions of dollars into AI infrastructure, while free cash flow remains under pressure. Under normal circumstances, that combination should have been a reason to sell the stock. But that's not what happened. Instead, Wall Street became even more optimistic. So, what changed? Was it simply because Amazon beat earnings expectations? Or did investors finally see something much bigger? In this video, we'll look beyond the headline numbers to understand why AWS completely changed the market's narrative. More importantly, we'll explore why this earnings report may mark the beginning of a new phase in Amazon's AI story, one where AI is no longer just a massive investment, but a powerful engine for future growth and profitability. At first glance, Amazon delivered exactly what investors wanted to see. Revenue came in ahead of expectations, earnings were stronger than forecast, and AWS posted its fastest growth in years. The company also reaffirmed its commitment to investing aggressively in AI infrastructure, even as capital spending continued to rise. On the surface, this looked like another solid earnings report. But Wall Street wasn't celebrating the numbers alone. Investors were reacting to what those numbers revealed about Amazon's future. This quarter suggested that AI demand is accelerating faster than many expected, and that Amazon is beginning to turn its enormous AI investments into real business momentum. That's why this earnings report felt different from previous quarters. To understand why this quarter mattered, we first need to understand the narrative before the earnings report. For months, many investors believed Amazon was entering an increasingly risky phase. The company was pouring enormous amounts of capital into AI infrastructure, yet the financial returns were still difficult to measure. At the same time, Microsoft appeared to be gaining momentum in enterprise AI, raising concerns that AWS might be losing its leadership position. The biggest question wasn't whether Amazon could build AI infrastructure, it was whether those investments would ever generate enough growth and profitability to justify the cost. That was the fear hanging over the stock, and it shaped investor expectations going into this earnings report. Then came the biggest surprise of the quarter. AWS didn't just grow, it accelerated to its fastest pace in several years. That mattered because AWS is Amazon's most profitable business and the foundation of its entire AI strategy. For investors, stronger AWS growth wasn't simply another positive number. It was the first clear sign that Amazon's massive AI investments were beginning to translate into stronger customer demand and faster cloud adoption. In other words, Wall Street no longer saw AI as a promise for the future. They started seeing evidence that AI was already strengthening Amazon's core business. And that single shift changed the entire conversation around the company. This is where the psychology of the market changed. Before this earnings report, every dollar Amazon spent on AI was viewed as another expense that would pressure profits and cash flow. But after seeing AWS accelerate, investors began interpreting those same investments very differently. Instead of asking, "How much is Amazon spending?" they started asking, "How much future growth is Amazon creating?" That's a fundamental shift in mindset. The focus moved away from short-term costs and toward long-term earnings power. In the market, perception often changes before the financial statements do, and this quarter may be remembered as the moment that perception changed for Amazon. Normally, a company announcing even higher capital spending would make investors nervous. More investment usually means lower free cash flow, lower margins, and greater execution risk. But Amazon's latest earnings challenged that logic. Instead of questioning the size of its AI investments, Wall Street focused on the reason behind them. Management made it clear that the company isn't building AI infrastructure in anticipation of future demand, it's expanding because customer demand already exceeds available capacity. That distinction changes everything. When investment is driven by proven demand rather than hope, it stops looking like a risky expense and starts looking like a profitable opportunity. That's why bigger AI spending became a positive signal instead of a warning sign. One of the most important parts of Amazon's earnings wasn't in the financial statements, it was in what CEO Andy Jassy said. He explained that demand for AI services continues to outpace the company's available capacity. In other words, Amazon isn't investing billions of dollars because it hopes customers will come. It's investing because many customers are already waiting for more computing power. That's a crucial difference. It tells investors that AI infrastructure is no longer being built for an uncertain future. It's being built to meet demand that already exists today. And when management delivers that message with confidence, Wall Street becomes much more willing to accept higher spending in exchange for stronger long-term growth. This may be the biggest takeaway from Amazon's earnings. For the past 2 years, the AI story was dominated by one word: investment. Every major tech company was spending billions of dollars to build data centers, buy AI chips, and expand cloud infrastructure. But Amazon's latest results suggest the story is entering a new phase. AI is no longer just consuming capital, it is beginning to generate measurable business value. Stronger AWS growth, improving profitability, and sustained customer demand all point to the same conclusion. Investors are starting to see a direct connection between Amazon's AI investments and its financial performance. And that's exactly why the market's narrative has changed. The success of AWS means much more than faster cloud growth. It changes the quality of Amazon's entire business. While retail remains the company's largest source of revenue, businesses like AWS and digital advertising generate significantly higher margins. As these segments become a larger part of Amazon's overall earnings, investors begin to see a company with stronger profitability and greater long-term earnings power. That's why Wall Street is becoming more optimistic. They're not simply forecasting higher revenue next quarter, they're anticipating a business mix that can produce higher returns for many years to come. In other words, AWS isn't just driving growth anymore. It's reshaping how investors value Amazon itself. The market is always forward-looking, and that's exactly what happened after Amazon's earnings. Investors aren't buying the stock because of one strong quarter. They're asking a much bigger question: what could Amazon look like 3 to 5 years from now if AI demand continues to grow? If AWS keeps expanding at this pace, and if AI services become a larger contributor to revenue and profits, Amazon's long-term earnings power could be significantly higher than many analysts previously expected. That's why this quarter matters so much. It may not have changed Amazon's business overnight, but it changed how investors are thinking about the company's future. And sometimes, that's enough to justify a higher valuation today. Of course, a stronger narrative doesn't eliminate the risks. Amazon still plans to spend heavily on AI infrastructure, and those investments must continue delivering real returns. Competition from Microsoft, Google, and other cloud providers remains intense, while any slowdown in enterprise technology spending could reduce demand for AI services. There's also execution risk. Building massive data centers and expanding global AI capacity is expensive and complex. If revenue growth slows while capital spending stays elevated, investor sentiment could change again. So while this earnings report marked an important turning point, the next few quarters will determine whether Amazon can consistently turn AI leadership into sustainable earnings growth. Looking back, this earnings report wasn't just about beating expectations. It marked a potential turning point in how Wall Street views Amazon's AI strategy. For the first time, investors saw convincing evidence that massive AI investments are translating into stronger cloud growth, healthier profitability, and growing customer demand. The narrative has shifted from asking whether Amazon is spending too much on AI to asking how much value those investments can create over the next decade. That's a profound change in market psychology. And if this trend continues, this quarter may be remembered not as Amazon's best earnings report, but as the moment its AI story entered an entirely new phase. So, what really changed after Amazon's latest earnings? It wasn't just a stronger quarter or faster AWS growth. Wall Street changed the way it values the company. For years, investors focused on how much Amazon was spending on AI. Today, they're increasingly focused on what those investments can earn in the future. That's a fundamental shift in perspective. Of course, Amazon still faces execution risks and intense competition, and one quarter doesn't guarantee long-term success. But if AWS continues converting AI demand into profitable growth, this could be remembered as the quarter when Amazon's AI strategy moved from building infrastructure to creating lasting shareholder value. And that's why the AI story has truly entered a new phase. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.